Ever feel like investing is this giant puzzle? Like, you just can't quite crack it.
Yeah.
You're not alone.
It can definitely be intimidating.
That's why today we're diving into investing for beginners, and hopefully we're going to turn all that financial anxiety into confidence.
Absolutely.
Stick with us, and by the end, you'll have the foundation to start building real wealth.
That's right, not just daydreaming about it.
So let's jump right in.
That sounds good.
I'm Terry, your guide to the world of finance.
And I'm Sheri, here to make sense of it all, hopefully.
Without the jargon.
Yes, exactly.
Before we get started, don't forget to hit that like button and subscribe for more deep dives into topics you care about.
Yes, please do. And let us know in the comments what financial mysteries you want us to tackle next.
Exactly.
We love hearing from you.
Now, if you're hungry for more, you can swing by our Patreon at patreon.com/5McAllister for bonus content and early access.
Yes. And if you're feeling extra generous and appreciate what we do, you can buy us a coffee at buymeacoffee.com/Jamie McAllister.
All right, quick disclaimer before we really get started.
Yes, of course.
We are not financial advisors.
That's right.
This is for entertainment only.
Yes.
Consult a professional for real-world money moves.
Definitely.
Okay, so imagine investing as planting a money tree.
Okay.
You put in some effort up front, you nurture it over time, and ideally,
And watch it grow.
you watch it grow. But instead of soil and water,
Right.
we're talking stocks, bonds, maybe even real estate down the line.
Uh-huh.
Definitely no Chihuahua breeding farms, though.
Unless you've really done your research.
I gotta really do your research for that one.
Yeah, that's a niche market.
So many people think of investing as gambling.
It's understandable, right?
That's understandable. The market can feel unpredictable.
Oh, yeah.
But investing is about putting your money into assets with the potential to grow,
Exact.
not just rolling the dice.
It's not a casino.
So when we talk about the stock market, are we talking about like owning a piece of a company?
Yes, exactly.
Okay.
Like, let's say you buy a share of Apple.
Okay.
You now own a tiny little slice of that tech giant.
I'm a part owner of Apple.
You are, in a way.
That's pretty cool.
Yeah.
But so as a beginner, do I need to try and discover the next Apple?
You know, that's a common misconception.
Yeah.
You don't need to try and find this, like, hidden gem right away.
Okay.
Focus on the companies, you know,
The ones I know?
the ones with proven track records,
Okay.
what we call blue chip stocks.
Blue chip stocks, got it.
Yeah.
Okay. I've heard the term portfolio thrown around a lot.
Yes.
What exactly is that?
Okay, so think of it like a playlist, but for your investments.
Okay.
A mix of different assets, stocks, bonds, maybe even real estate later on,
Okay.
all working together to create long-term growth.
So you're saying don't put all your eggs in one basket?
Precisely. That's where diversification comes in.
Okay.
Imagine your portfolio like a delicious party mix.
Okay.
You want a variety of flavors and textures, not just a bowl full of pretzels, right?
Right. So if one type of investment isn't doing so hot, the others can kind of help cushion the blow.
Exactly. You want to spread your investments across different companies, different industries, and even types of assets.
Got it.
That's how you build a portfolio that can weather the ups and downs of the market.
This is starting to sound like a game plan, but what about like the mental side of investing?
Yeah.
I know I get caught up in the hype sometimes.
Oh, yeah, for sure.
How do you stay level-headed?
One of the biggest misconceptions is that it's about getting rich quick.
Yeah, get rich quick.
Yeah, when in reality, the real key is patience.
Patience.
The market will have its mood swings,
What-
but historically, it trends upwards over time.
Over time. Okay,
So
yeah.
cultivating a long-term mindset is crucial. It's a marathon, not a sprint.
I like that analogy.
Yeah.
But how do you avoid decisions like when the market dips?
Yeah.
You know, I feel like I'd be tempted to sell everything and just hide.
Oh, I think we've all been there.
Yeah.
It's natural to feel that way, but reacting impulsively is usually the worst thing you can do. Remember, dips are normal. If you've invested in solid companies and diversified your portfolio, you're likely to come out ahead in the long run.
Okay.
It's about trusting the process and not letting fear drive your decisions.
So it's more about weathering the storm
Exactly.
than trying to time the market perfectly.
Yeah, nobody can time the market perfectly.
Okay, good.
And for beginners, one of the best ways to navigate this is through index funds and ETFs.
Okay, I've heard these terms, but I'm still a little fuzzy on what they actually are.
Okay, so imagine walking into a bakery, and instead of choosing individual pastries, you opt for a sampler platter.
I like this.
Okay.
I like where this is going.
You get a taste of everything without having to commit to a single item.
Okay.
That's essentially what an index fund or ETF does for your portfolio.
So it's like a pre-made diversified bundle of stocks.
Precisely. They track a specific market index, giving you instant diversification across hundreds or even thousands of companies with lower fees.
Wow.
They're like the beginner-friendly easy button of investing.
That sounds pretty appealing, but with so many index funds and ETFs out there,
Right.
how do you choose the right one?
That's a great question. But before jumping into specific funds, let's talk about something even more important:
Okay.
managing risk.
All right. Risk management. That sounds a bit intimidating.
It doesn't have to be. Think of it as setting up guardrails for your investments.
Okay.
Okay, the first rule:
Okay.
never invest money you absolutely can't afford to lose.
Got it.
Your emergency fund, rent money that's off limits.
So it's about knowing your boundaries and not putting yourself in a financially precarious position.
Exactly. And another crucial aspect is understanding your own risk tolerance.
Risk tolerance.
How comfortable are you with the idea of your investments fluctuating in value?
No?
Some people thrive on the excitement of a roller coaster market,
They love it.
while others prefer a smoother ride.
They just want to chill.
Yeah, exactly.
Yeah.
So it's about knowing yourself and how much risk you can stomach without losing sleep at night. If you're more risk averse, you might lean towards a larger portion of bonds in your portfolio.
Okay.
They tend to be less volatile than stocks, although they typically have lower returns.
Got it.
It's about finding the right balance for you.
So there's no one-size-fits-all approach. It's about tailoring your investment strategy to your individual needs and comfort level.
Exactly. And that's where education comes in.
Education.
Don't be afraid to read research and even consider talking to a financial advisor if you need personalized guidance.
So for someone ready to take that first step, what are the practical things they need to do to actually start investing?
Well, we've talked about choosing a brokerage account, which is your online investing hub. But before you even pick a platform, one of the best things you can do is to simply start learning.
So it's about empowering yourself with knowledge before diving headfirst into the market.
Exactly. You can read books, listen to podcasts, watch videos. There's a wealth of information out there.
So knowledge is power when it comes to investing.
Absolutely. Once you have a basic understanding, then you can start thinking about opening that brokerage account and choosing your first investments.
Okay, so we've covered a lot of ground already. We've talked about what investing is, the importance of diversification,
Right.
developing the right mindset, and managing risk. But what about the actual mechanics of investing?
Yeah.
How do you actually buy stocks, bonds, or those beginner-friendly ETFs?
That's a great question and something we'll definitely delve into in more detail. But before we get into the nitty-gritty of placing trades and navigating a brokerage platform, there's one more crucial concept we need to discuss.
Okay, I'm intrigued. What is it?
It's the concept of dollar cost averaging.
Dollar cost averaging.
It's a simple yet powerful strategy that can take a lot of the stress and guesswork out of investing.
Right. Dollar cost averaging. I'm all ears. Let's break it down.
So instead of trying to time the market perfectly,
Which is impossible.
which, let's be honest, is nearly impossible to do consistently, dollar cost averaging involves investing a fixed amount of money at regular intervals,
Okay.
regardless of what the market is doing.
So it's about taking emotion out of the equation
Yes.
and establishing a consistent, disciplined approach.
Exactly. Think of it like building a brick wall.
Okay.
Each investment is a brick. And over time, you steadily build your portfolio brick by brick, regardless of the weather outside.
That's a great analogy.
Yeah.
So instead of getting caught up in the daily market fluctuations, I'm focusing on the long-term consistent growth of my portfolio.
Precisely. And that's the beauty of dollar cost averaging.
Okay.
It not only simplifies the process, but also helps you average out your purchase price over time, mitigating the risk of buying high and selling low.
This is starting to make a lot of sense. So dollar cost averaging is like the steady tortoise in the race against the impulsive hare of market timing.
Exactly. Slow and steady wins the race when it comes to investing.
Okay, so we've covered the what, the why, and the how of investing, but I'm sure many of our listeners are still wondering, where do I actually start?
That's a great question, and it's one we'll tackle head-on in our next segment. We'll walk you through the practical steps of opening a brokerage account, choosing your first investments, and building a portfolio that aligns with your goals and risk tolerance.
So stay tuned, folks. We're just getting started.
Absolutely. So we've laid the groundwork. We understand what investing is.
Right.
The importance of diversification.
Uh-huh.
The need for a long-term mindset.
Yep.
Now let's address that burning question.
Okay.
Where do I actually begin?
Yeah, that's the million-dollar question, right? We've talked about brokerage accounts, but with so many options out there, can it feel kind of overwhelming?
It's like walking into a giant supermarket for the first time.
Okay.
Aisles and aisles of choices, and you're just standing there
To the empty basket.
with an empty basket wondering where to start.
Okay, yeah, that's a perfect analogy.
Yeah.
So how do we navigate this financial supermarket and choose the right Brokerage account.
Think of it like this. You wouldn't buy a car without comparing prices, features, reviews, right? Choosing a brokerage is similar. You want to look at factors like fees, account minimums,
Okay.
the types of investments they offer, the overall user experience.
Fees are a big one. We don't want to be giving away, chunks of our hard-earned money just to trade.
Exactly. Luckily, many brokerages today offer commission-free trading on stocks and ETFs.
Wow.
That means you can buy and sell without paying a fee each time.
Okay, that's a game changer.
It is.
So what about those account minimums? Do I need to be a millionaire to even get started?
Not at all.
Okay, good.
Many brokerages have no minimums these days.
Really?
You can literally start investing with just a few dollars.
Wow, that's incredibly encouraging.
It is.
It makes investing accessible to just about anyone.
Yeah.
So beyond fees and minimums, what else should we be looking for in a brokerage?
You want a platform that's easy to use and understand, even if you're a complete beginner.
Okay.
Look for features like educational resources, portfolio tracking tools,
Okay.
and maybe even a mobile app so you can manage your investments on the go.
So it should be intuitive,
Yes.
empower you, not confuse you even more.
Exactly. And don't underestimate the importance of good customer service.
Oh, yeah.
If you have questions or encounter any issues, you want to be able to reach a real person who can help you out.
Right. So it's about finding a platform that feels like a partner in your investing journey,
Yeah.
not just a faceless corporation.
Precisely. And once you've chosen your brokerage, the next step is deciding where to actually put your money.
Okay, so we've got our shopping cart ready. What should we be filling it with?
Remember those sampler platters we talked about earlier?
Yes.
Index funds and ETFs.
Okay.
They're a great starting point. They offer instant diversification
Okay.
and allow you to invest in a basket of stocks that track a specific market index like the S&P 500.
So instead of trying to pick individual winners and losers,
Yeah.
I'm basically getting a slice of the entire market pie.
Exactly. It's a lower risk approach, especially for beginners, and it's aligned with that long-term slow and steady philosophy we've been talking about.
Right.
Yeah.
Makes sense. But with so many different index funds and ETFs to choose from,
Right.
how do you know which one's right for you?
Well, that's where your financial goals and risk tolerance come into play.
Okay.
Are you investing for retirement, which is decades away?
Uh,
Or are you saving for a down payment on a house in the next few years?
okay.
Your time horizon will influence the types of funds you choose.
So someone with a longer time horizon can afford to take on a little more risk
Right.
and potentially opt for funds that focus on those growth stocks.
Exactly. While someone with a shorter time horizon might prioritize stability
Oh,
and choose funds that hold a larger percentage of bonds.
got it. So we're thinking about our goals, our risk tolerance, and choosing funds that align with those factors.
Yeah.
What about the actual process of buying and selling these investments?
Most brokerage platforms are incredibly user-friendly these days.
Okay.
Think of it like online shopping, but for investments.
Okay.
You search for the ticker symbol of the fund you want,
Oh.
enter the number of shares you want to buy, and click confirm.
So it's really that simple.
It can be, and remember, you don't need to invest a huge sum of money all at once. You can start small
Okay.
and gradually increase your contributions over time.
That's reassuring, especially for those of us who are just dipping our toes in the investing waters.
And speaking of dipping your toes, remember that concept we discussed earlier, dollar cost averaging.
Yes.
It's a great way to build your portfolio gradually and take the emotion out of investing.
Right. That's where we invest a set amount of money at regular intervals, like clockwork, regardless of what the market is doing.
Exactly. This strategy can be especially beneficial for beginners because it helps you ride out the inevitable market fluctuations and prevents you from making impulsive decisions based on fear or greed.
Right. So instead of trying to time the market perfectly, which, let's be honest, is nearly impossible,
It is.
we're focusing on consistent, disciplined investing.
Precisely. And that's how you build wealth over the long term, brick by brick, investment by investment.
Okay, this is starting to feel less like a daunting climb up Mount Everest
Yeah.
and more like a scenic hike with breathtaking views along the way.
That's a great way to put it. Investing doesn't have to be intimidating or overwhelming.
Right.
With the right knowledge, tools, and mindset, it can be an incredibly rewarding journey.
So we've chosen our brokerage. We've selected our investments. We're practicing dollar cost averaging. We're feeling good about our long-term strategy.
Right.
What else do we need to know to truly thrive in this world of investing?
That's a great question. And it leads us to another important concept, understanding different investment styles.
Okay.
Because even within the realm of index funds and ETFs,
Right.
there are different approaches to consider.
Okay, I'm intrigued. Tell us more about these investment styles.
Well, two of the most common styles are value investing
Oh,
and growth investing.
got it.
Value investors, like bargain hunters, look for companies that are undervalued by the market.
They're looking for deals.
They believe these companies have strong fundamentals, but are temporarily out of favor with investors.
So they're looking for like hidden gems companies with the potential to shine brighter in the future.
Exactly. Growth investors, on the other hand, focus on companies that are expected to grow at above average rates.
Okay.
They're less concerned with current valuations and more interested in companies with innovative products, expanding markets, or disruptive technologies.
So they're betting on the companies that are shaping the future, even if those companies are currently priced at a premium.
Exactly. And both approaches have their merits and risks.
Right.
Value investing can offer the potential for higher returns, but also comes with the risk that those undervalued companies might never reach their full potential.
While growth investing can capture the upside of innovation, but also carries the risk that those high-growth companies might not live up to the hype.
Precisely. And as a beginner, you don't need to choose one style over the other.
Yeah.
You can diversify your portfolio by investing in funds that represent both approaches.
So it's about having a balanced approach, not putting all your eggs in one stylistic basket.
Exactly. And the beauty of index funds and ETFs is that they often provide exposure to a blend of different investment styles,
Right.
further enhancing your diversification.
This is starting to feel like a masterclass in investing for beginners. We've gone from feeling overwhelmed to having a solid grasp of the fundamentals.
Good. I'm glad.
But before we wrap up this segment, is there anything else you want to emphasize about choosing the right investments?
One final thought. Don't be afraid to do your own research.
Okay.
Read fund prospectuses, look at historical performance data, and compare expense ratios.
So really do your homework.
Yes, the more informed you are, the more confident you'll feel about your investment decisions.
So it's about taking ownership of your financial journey and not just blindly following the crowd.
Exactly. Investing is an ongoing process of learning and adapting, and the more you engage with it, the more empowered you'll become.
This has been incredibly insightful. We've covered everything from choosing a brokerage to understanding different investment styles.
Right.
But before we send our listeners off to conquer the world of investing, let's talk about one more crucial aspect:
Okay.
managing risk.
Absolutely.
Yeah.
Because even with a solid plan and diversified portfolio, there are always risks involved in investing, and understanding those risks is crucial to making informed decisions and protecting your hard-earned money.
All right, so we've covered a ton of ground, picking a brokerage, choosing investments, even dipping our toes into different investing styles.
Yeah,
But as you mentioned, no investment is completely risk-free.
that's right. And understanding the types of risks you might encounter can actually be empowering. It's not about eliminating risk entirely, but about managing it intelligently.
Okay, so let's demystify this whole risk thing.
Yeah.
What are some of the key risks that investors need to be aware of?
One of the most common is market risk. This is the inherent volatility of the market itself. Economic downturns, geopolitical events, even investor sentiment can cause the overall market to fluctuate.
So even if you've picked solid companies and diversified your portfolio, you can still experience losses if the entire market takes a nosedive?
Exactly, and that's why having a long-term perspective is so crucial.
Yeah.
Short-term fluctuations are inevitable, but historically, the market tends to trend upwards over time.
So it's about riding out those waves and not panicking when things get choppy.
Precisely. Now, another type of risk is specific to the companies or assets you invest in.
Okay.
We call this company-specific risk or unsystematic risk.
So this is about the individual performance of a particular company, regardless of the overall market conditions.
Exactly. A company could face challenges due to poor management, increased competition, or even unforeseen events like natural disasters.
So even if the market's doing well, a single company's stock could plummet if they face internal struggles.
Exactly, and that's why diversification is so crucial. By spreading your investments across different companies, industries, and even asset classes, you can mitigate the impact of any single investment going south.
It's like having a safety net for your portfolio.
Exactly.
Okay, so we've got market risk, we've got company-specific risk. What else?
Another important one is interest rate risk.
Interest rate risk.
This primarily affects bond investments.
Okay.
When interest rates rise, the value of existing bonds tends to fall.
So if I've invested in bonds and interest rates start climbing, I could potentially lose money.
That's right. However, it's worth noting that interest rate risk is generally lower for shorter-term bonds.
So if I'm investing in bonds for a shorter time horizon, I'm less exposed to the potential impact of those rising interest rates.
Exactly. And finally, there's inflation risk.
Inflation risk.
This is the risk that the purchasing power of your money erodes over time due to rising prices.
So even if my investments are technically growing, if inflation is outpacing those returns, my money isn't actually going as far as it used to.
Precisely. And this is where investing in assets like stocks, which have historically outpaced inflation over the long term, can be beneficial.
Okay, so we've got a pretty good understanding of the different types of risks involved in investing. But what are some practical steps we can take to manage these risks and protect our investments?
Well, we've already touched on some key strategies: diversification, having a long-term perspective, and investing in assets that align with your time horizon and risk tolerance.
Right, those are the foundational pillars of risk management.
Exactly. And on top of that, it's crucial to stay informed, keep up with market news and trends, research the companies you're investing in, and pay attention to economic indicators.
So knowledge is power when it comes to risk management.
Absolutely. And don't be afraid to seek guidance from a financial advisor if you need help navigating these complexities.
Right, especially when it comes to making those big financial decisions. Okay, so we've covered a lot of ground today.
We have.
We've gone from feeling overwhelmed by investing to having a roadmap for getting started, choosing investments, and managing risk.
It's been quite a journey. And remember, investing is not a destination. It's an ongoing process. It's about staying curious, continuously learning, and adapting your strategies as you go.
So the key takeaway here is that even though investing involves risks, those risks can be understood and managed with the right knowledge and approach. It's not about eliminating risk altogether, but about making informed decisions and building a portfolio that can weather the inevitable storms.
Well said. And remember, you don't have to go it alone. There are resources available, from books and websites to podcasts like ours, and even professional financial advisors who can provide personalized guidance.
Right. There's a whole community of support out there for anyone who wants to embark on this investing adventure.
And that's what's so exciting about it. Investing can be a powerful tool for achieving your financial goals and creating a more secure future for yourself and your loved ones.
So what are you waiting for? Take that first step, empower yourself with knowledge, and start investing in your future today.
Absolutely.
And that wraps up another deep dive here on The Deep Dive.
Yes, it does.
Don't forget to like and subscribe for more insightful episodes.
And let us know in the comments what financial topics you'd like us to explore next.
Exactly. And if you're ready to level up your financial game, head over to our Patreon at patreon.com/McAllister for exclusive content and early access.
And if you're feeling extra grateful for the knowledge we've shared today, you can buy us a coffee at buymeacoffee.com/Jamie McAllister. Every little bit helps us keep the deep dives coming.
Remember, we're not financial advisors, so consult a professional for personalized advice.
Always a good idea.
Until next time, stay curious, stay informed, and happy investing.
See you next time.